Hi everyone, today we're going to present you Red Hat. Let's start with the history of the company. Red Hat was created in 1993 by Bob Young and Mark Ewing. In 1997, the first commercial support was developed for Red Hat was on Linux 5. In 2001, Red Hat created Red Hat Consulting to extend the range of the services. In 2007, Red Hat was the only OS offered on Amazon Cloud, which is one of the biggest in the world. In 2012, Red Hat took the next step to be certified by KVM and IBM servers. And as we know, IBM finally took over Red Hat in 2018. To talk a bit about the management, the chairman of the group, Narendra Gupta, is in the Indian capital investors, and he gives counsel to a lot of investors around the world. The CFO, Eric Shander, is kind of the technical guy in the company because he previously worked at Lenovo and IBM. And the CEO, James Whitehurst, joined the company in 2007 and worked at BCG and Delta Airlines before joining Red Hat. The ownership, Red Hat is mostly owned by asset management company, so we can count T. Rowe Price, Vanguard, Jennison, and also BlackRock and Fidelity, which are really big players in asset management world. So we can understand that Red Hat is a very serious and good company because those company doesn't get involved in doesn't good company. About the market analysis on the IT and communication market, it is constituted mostly by 4 activities, so data centers, IT services, enterprise software and devices, and telecom services. And the global IT service market represents more than 800 billion in 2018, and we can expect this market to be more than 1 trillion in 2020. The year-on-year growth will be strong in the next years with more than 5% per year, and we can see that all the activities in the IT services, so cloud migration, AI, IoT, and analytics. To have a view geographical about the market, so the USA have the biggest part in the market. The Europe has about 1/3 of the market, and the rest is in India and Asia in general. About the competitors panel, we can see that the competitors are really big in the market because there are Microsoft, IBM, who finally took over Red Hat, Hewlett Packard, but also Oracle. So Red Hat is the new big player around this in the market. So Red Hat propose cloud services. So what's the benefit in it? It principally reduces the investment in the hardware software for companies. It lowers the maintenance because of the open source characteristic of cloud. It reduces the accounting constraint related to IT depreciation. It ends the migration project when there's major in between companies, and it reduces the cost of deploying a new application. And here are the competitive advantages of Red Hat. So they give great support for their customers. They propose care and consultation service. It allows them to enhance the value of offering for their clients, and they also have emerging technology that they can provide to clients. So basically they help customers with strategic decision and that allow them to expand their portfolio. So now Mathieu will give you a more financial view of Red Hat.
The world is actually turning towards the cloud, IT services, artificial intelligence. IoT coupon annual growth rate is 19.92%. Cloud coupon annual growth rate is 18.5%. This new demand can explain the increase of the revenue. Thanks to the demand increase, Red Hat has the biggest sales volume directly linked toward its subscription. Thus, the revenue also is directly toward the pricing power of Red Hat. We analyze 5 different products of Red Hat, and we can notice that there is an increase of the selling price of 10%. As we said in the last presentation, the revenue is split in 2 parts, the subscription and the training and services. Since 2016, the revenue grew by 42% in total. The subscription in 2018 represents 88% of the total revenue, and the training and services represent 12% of the total revenue. We finally can forecast a revenue growth about 50%. About the external growth, with enterprise application in demand and health, IT, and the cloud base in cybersecurity target by the buyers, it has been a busy 2018 year. The last SaaS include M&A market report from international technology merger and acquisition experts. Clinton partners show that the enterprise application of the driving force behind a bumper start to deal marketing in 2018. Deals volume in the sector rose 27% compared to the first quarter 2017, with a total of 269 deals. For acquisition reached the billions dollar milestone in the 3 months of the year, twice as many as the same period last year. According to these trends, we are not surprised about Red Hat recent acquisition, such as the acquisition of Nuba closed the 27th November in 2018. The acquisition of Koreos closed the 30 January 2018. The acquisition of Permabit Technology Corporation closed to the 31 July 2017. All of these acquisitions have one of common point. They boost Red Hat market share and growth potential, leading the global growth of the company through the external growth. Now let me speak about the margin and the cost analysis. The margin analysis is the first step while conducting financial analysis. It's allowed to understand how the results in create and what are the key points impacting the company in terms of profitability. First, we will look the gross profit margin, which is basically a financial metric used to assess a company financial health and business model by revealing the proportion of money left over from the revenue after accounting the cost of goods sold. Like we can see, the Red Hat gross profit margin is very high compared to these opponents. Is stable since 2016, approximately at 85%. Its amount went to due to the high increase of the sales. The amount went to approximately 1.7 billion to 2.5 billion dollar, while the competitor margin is more about 40%. Secondly, we will focus on the EBITDA margin, which is an assessment on the firm operating profitability as a percentage of its total revenue without considering the depreciation and amortization policy, which can be twisted by the company somehow. Their EBITDA margin is quite lower compared to the opponents, but we can explain that by the expense of the marketing were very high. Also the research and development and general administration. We can assume that Red Hat SG&A and is more important than this competitor. Actually, Red Hat overall costs are composed 76 of SG&A costs, while its cost of goods sold are 24%. This can explain the huge difference between the gross profit margin and the EBITDA. Thus, this resonates with Red Hat's business model, which requires a lot of manpower and less infrastructure. The last but not the least, the EBIT margin, as known as the operating results, which reflect the capacity of the company to make a profit. As of 2018, it is at 16%, while the competitor is more around 15%. To bonds with the net income, we notice that there is a difference of approximately 4% between the EBIT and the net income margin each year. This can be explained by the high financial charges that Red Hat bears due to his high debt amount that we will see later. We obviously clear the statement of any exceptional result to reflect Red Hat core efficiency. We can conclude this part by the analyzing of the Sizer effect. As we can see, there is a huge rise of the sales and expense, but if we take a deeper look, the expenses are controlled and growth slower than the sales. We won't be able to address the internal margin risk analysis as we don't possess the relevant information. Now Carla will speak about the investment.
Okay, so in terms of current liabilities, they remain stable. We can also point out that the company generates a lot of cash thanks to the business model, which means that the company has more resources stuck into the business, which are in fact frozen. So as this tendency is increasing, the company should be careful and control the rise of its working capital. In fact, we can actually choose to focus the working capital from operation, excluding cash, short-term financial investment, and some current assets. We find, and by doing this, we find a negative working capital of minus 10 million, which is the working capital from the continuous operations, with an increase of 8 million net change. So now in terms of investment strategy, the analysis can be separated into three main points. So the amount of investment, what is the investment policy, and whether they are profitable or not. So the PPE, as we have previously stated, are not relevant, so they remain stable, ranging from 170 to 210 within the last year. So the amount of investment in PPE results in the compensation of the loss due to the DNA. They also invest a decent amount in short-term debt securities and long-term debt securities as they generate a lot of cash, as we saw earlier. So therefore, Red Hat chooses to invest this cash in debt securities instead of their workforce. But why is the question? So we've assumed that it's probably because that they are not yet able to maintain a superior growth rate, which will result in an increased investment in their SG&A. Okay, so now moving on to the workforce and investments. So as we saw during the margin analysis, the Red Hat business dwells well within the workforce, as the workforce went from 1 billion to 1.6 billion in 3 years, which represents a 60% increase. So basically, for $1 invested in the SG&A, there's a result of an increase of their sales of $2. And in terms of EBIT, there's an increase of $0.32. So in consequence, they can highly invest in research and development with a percentage increase of 30% within 2017 and 2018. So without these investments, the return on investment from the SG&A wouldn't be as high as it is right now. What we'll look into is the future investment plan. So in 2019, Red Hat plans on pursuing 4 different strategies, 4 plans. The first one being driving the widespread adoption of their offerings, then investing in the development of open source technologies and promoting the use of these technologies by software developers. Also globally pursuing strategic acquisitions and alliances. And lastly, promoting a range of services to help their customers derive additional value, which requires talent acquisition, obviously. So in the case of Red Hat, it's important to focus on efficient capital allocation or to complete its stock option-based policy. The reason why may also be to reread its shareholders thanks to the accredited nature of the operations. And additionally, we can also point out that Red Hat makes frequent buybacks. The last one was actually in June 2018. $1 billion worth of shares were repurchased through a program that was installed, which replaces the last program, which has now expired. Okay, so now we're going to move on to the funding part of the Red Hat analysis. So in terms of capital structure, there are two main types of funding, funding by debt and funding by equity. So in Red Hat's case, the investment policy is predominantly financed by debt, which represents 52% in 2018. So Red Hat has actually proceeded to increase its debt funding with the aim of carrying out new projects and investment in research and development. So when we break down the liabilities of Red Hat, we can see that the long-term debt represents the largest share by far, with a total of 75%, as you can see on the graph here. And then later, during the computation of the return on equity, we will consider the link between the debt-equity ratio, the cost of debt, and the economic rentability, so what we call the ROCE ratio. And so therefore, we can also analyze the absolute level of debt at a given moment and the capacity of the company to face annuities without facing a liquidity crisis. So let's then look at the debt capacity. So we will analyze this by looking first of all at the net debt divided by the EBITDA, so what we call the leverage. So in Red Hat's case, the leverage in 2018 is 1.35. It has indeed decreased by 32% over the 2016 and 2018 period, which means that there's a higher reimbursement capacity due to an increased amount of the EBITDA. Now moving on to the interest coverage ratio here, it measures how many times the company can pay its current interest with the payment of its available earnings. So in Red Hat's case, once again, it's increasing and reaching 22.21 in 2018, so this represents a very good debt reimbursement capacity. Okay, so now we're going to look at the liquidity of Red Hat and if there's a liquidity risk that's incurred. So for that, we're going to look at two main ratios. So the first one is the current ratio. So here we can see that it's greater than 1. So Red Hat is capable of paying its obligations because it has a larger proportion of short-term asset value in relation to the value of its short-term liabilities. And now in terms of the quick ratio, we can see that it's greater than 1. So Red Hat can instantly get rid of its current liabilities. So in 2018, the quick ratio is 1.4, which indicates that Red Hat has a for $1.4 of liquid assets available, it's able to cover $1.36 of its current liabilities. Okay, so now we're going to move on to...
On l'a refait à la fin. Je me suis arrêté pendant 5
Ouais,
secondes.
pardon. Oh là là. Juste, tu fais quoi toi? C'est quoi ton nom?
Je fais. On va.
Okay, so now we're gonna move on to Idir's part, which is the analysis of profitability.
We have so far studied the formation of company margin, knowing that this requires investment in the form of changing working capital requirement or capital acquisition, and which must be, of course, financed by equity or debt. So we now have all the elements to make a diagnosis on the efficiency of the company, its profitability. So a company with a profitability at least equal to that demanded by its shareholder and creditor will not have long-term financing problem and will repay its debt and create value for shareholder. So speaking about the economic profitability, one can speak of profitability in relation to capital invested, but the result produced by this capital. Rentability can be perceived as the ratio between wealth growth, operating income, and invested capital. So our focus is on the profitability of economic assets measured by the ratio of operating income after taxes, known as NOPAT. We'll call it economic profitability. So firstly, the economic assets of the business are the sum of its fixed assets and working capital requirement. So that the company requires to run. It is therefore equal to the sum of its net outstanding committing by the company for its investment cycle. It is also referred to as invested capital or operational fund commitment. It is financed by, as we said before, equity or debt. So according to the definition, our economic assets are the sum of our fixed assets plus the working capital. As Red Hat is a software company which chose to include both the tangible and intangible assets, such as the goodwill for our fixed assets. Effectively, the goodwill which comprise the patents are an important part of the company wealth as a software company. Furthermore, the working capital will be the one from continuous operation as the cash excess is impacting our company. So the economic assets for 2017 were about 1,050 million with an increase to 1 billion 700 million in 2018, which represents an increase of 26%. So secondly, the operating income or operating profit is a result of the operating and investing process. So it reflects the increase in wealth generated by the industrial and commercial activity of the company. Unlike the EBITDA, which focuses only on the operating cycle, the operating result also considers the investment process through the calculated expense, such as the depreciation and amortization expense or provision for litigation, for example. So this result is then separated between the financial expenses and the corporate tax, the dividend and the dividend put in reserve. So this concept of operating income is extremely used, especially in the calculation of the economic profitability, because it's not affected by the financial structure. So it is really close to the EBIT. So the operating income after tax, known as NOPAT, was about 222 million in 2017, with an increase to 317 in 2018. So according to our metric, we can assess a return on capital employed, known as ROCE, of 17% in 2017 and this year at 19%. Secondly, the operating income or operating profit is the result of the operating and investing process of the year. It reflects the increase in wealth generated by the industrial and commercial activity of the company. Unlike the EBITDA, which focuses on the operating cycle, the operating income also considers the investment process through the calculated expenses, such as the depreciation, amortization expenses, or provision for litigation, for example. So the operating income after tax, known as the net operating profit after tax, the NOPAT, was about 222 million in 2017, with an increase to 316 in 2018. So according to our metrics, we can assess a return on capital employed, a ROCE, of 70% last year and this year about 19%. We will now be focused on the relation between the leverage effect and our actual return on equity, which assess the rentability of the shareholder capital. So the leverage effect explains the rate of return on equity based on the rate of return on economic asset and the cost of debt. So during the WACC computation, we found out a cost of debt of 2.24% as of 2018. So our ROCE was about 19%, as we said before, and the proportion of debt to the overall capital was of 34%. So according to this metric, we can compute a return on equity of 25%. So as we can notice, the return on equity is higher than the ROCE due to the leverage effect, as the cost of debt is really way lower than the cost of equity, which is about 6%. So to conclude the value creation, what we can know is that the company will be able for a given period of time to create value when it derives on its economic, as a NOPAT is higher than the cost of money, the WACC, that is mobilized to finance itself. So as we said before, a company with a profitability at least equal to that demanded by the shareholder represented by the WACC and the creditor will not have any financial long-term problem and will be solvency. So in our case, our WACC is of 4.76% this year, and our ROCE is about 19%. Thus, our cost of debt, as I said, is really low. So according to this, we can affirm that the company is creating high value, principally due to its competitive advantage introduced before by Robin, and also due to the low cost of debt that permit us to enhance the value creation thanks to the leverage. We will be focused on the value creation. So the company will be able for a given period of time to create value when it derives on its economic rentability, known as NOPAT, because the NOPAT, as you can see, is higher than the cost of money, the WACC, that is mobilized to finance itself. So as we said before, a company with a profitability at least equal to that demanded by its shareholder and creditor will not have a long-term financing problem, will repay its debt and create value for its shareholder. So in our case, our WACC is about 4.76% this year, and our ROCE is about 90%. Thus, our cost of debt, as I said, is really low. According to this, we can affirm that the company is creating high value, principally due to its competitive advantage that Robin introduced you before. So we will now try to price the company based on its WACC, its profitability, and its cash generation with Leila.
So now we'll try to assess the value of Red Hat using two different valuation methods, so the DCF and the Trading Comps, and we won't be using the Transact Comps because we rather focus our time in the two previous methods. So about the DCF, we forecasted a continuous growth expectation for Red Hat of 15%, thanks to the 47 equity analysts following the company. and we forecasted, based on the last year number and the expected growth, a free cash flow of less than 1 billion in 2018, and we expected it to expand to 1.2 billion in 2018 too. So we have to notice that our WACC, as we found earlier, was around 4.78%, and thanks to it, we're discounting the free cash flow during a 5 years horizon and calculate the terminal value according to Gordon Shapiro that we're discounting. So finally, we found like an enterprise value of $21 billion. So we derived exact multiple based on the revenues and EBITDA, leading us to an EV revenue of 6.4 and a EV divided by EBITDA of 31.3. Regarding the screening and so the comparables methods, we make a comparable universe of 7 companies evolving in the same sector we're at. So we include, for example, Microsoft and Oracle. And according to this one, we highlight the high, the low, and mean and medium EV revenues and EV EBITDA of the universe. So using this range, we assess the Red Hat multiples. So has EV divided by revenue, we found a 5.5 multiple, and for the EV divided by EBITDA, 29.4 multiple. So finally, about the valuation, we can assume a final multiple for Red Hat set between the DCF and the Tradicont valuation of 6.5 for the EV divided by revenue and 33 for the EV divided by EBITDA. And we found also a current revenue of 2,900 around and an EBITDA of 593. So finally, we by multiplying these two, we found a final value average, ranging from $19 billion to $20 billion. So with that final value average, we just assess an equity value range from around 18 billions and to 19 billions, and finally found a final share price range of $103 to $106, and it's based on price before IBM's acquisition, and it's quite important to say that.
So as we can see on the chart, the progression of Red Hat is quite impressive over the years, because 4 years before the stock was only $70, and now it's about $180. So we can see different phase on the stock. In December 16, they announced a partnership with IBM. So we can see the trend just on this announcement. After we can see the little decrease of the stock, but it's general in the stock market this year. But when the announcement of the merger between Red Hat and IBM, we can see that the trend is already really good, and that the stock is really higher than 3 months before. We can also see on this chart that the stock exchange is really healthy for Red Hat, because this is the volume of exchange every month since 2016. And we can see that the proportion of short stock volume is really low instead of the shares exchanged. So people that are buying Red Hat are buying it because they think it's a good company, and not shorting it to see it fall in the market. So here's the end of the presentation. So thank you for viewing our video, and see you.